Hello everyone, welcome back to Shiva Finance Academy. In this video, we are starting chapter 2 of class 11 accountancy, which is called theory base of accounting. This chapter is not about calculations, totals or numbers. This chapter is about understanding the thinking process behind accounting. Most students believe that accounting is a subject where rules are simply given and students are expected to memorize them. But that is not true. Accounting rules are not random. Every rule exists because of a logical reason, and this chapter explains the reason clearly. Theory base of accounting helps us understand why accounting is done in a particular manner. It explains why transactions are recorded, why some transactions are ignored, why profit are calculated in a particular way, and why financial statements follow a fixed structure. If this chapter is not understood properly, students usually face difficulty in later chapters such as accruals, provisions, depreciation, rectification of error, and final accounts. These chapters are built directly on the concepts explained here. Therefore, this chapter forms the foundation of accounting logic. I strongly advise you not to rush through this lecture. Listen patiently, understand the logic, and accounting will start making sense automatically. Now, let's understand what exactly is the term theory base of accounting. Accounting does not depend on personal opinion or personal convenience of an accountant. Instead, it is based on certain set of accepted principles, rules, and assumptions that are followed by business everywhere. The theory base of accounting refers to basic framework that guides how accounting records are prepared. It provides direction to accountants regarding when to record transactions, how to record them, and how to present them in the financial statements. If there was no theory base, then every business would prepare its own accounting on its own wish. One business might show profit in one way, another business might show profit in another way, and comparison would become really impossible. Because of theory base, accounting becomes uniform, reliable, and comparable. Users of accounting information such as owners, banks, investors, and government can trust the information provided in the financial statements. Now, let's look at the importance of theory base of accounting. The first important of the theory base of accounting is that it ensures uniformity in accounting practices. Uniformity means different business follow similar accounting rules, which makes financial statements comparable. The second importance is that it ensures a true and fair view of financial statements. Accounting theory prevents manipulation of profit and ensures that losses are not hidden. The third importance is comparability. Because accounting rules are consistent, we can compare financial result of one year with another year and one business with another business. The theory base also improves creditability of accounting information. When users know that the accounting follows accepted rules, they trust the financial statements more. Accounting is based on certain basic assumptions. These assumptions are so fundamental that they are automatically followed while preparing accounts, even if they are not written explicitly. These assumptions are called fundamental accounting assumptions because they form the starting point of accounting. Every accounting record is prepared by assuming that these assumptions are true. There are three basic accounting assumptions, that is, going concern, consistency, and accrual. These three assumptions together form the foundation of accounting. If these assumptions are removed, accounting records will lose their meaning, and accounting will fail to present a realistic picture of the business performance. Now let's understand, what does going concern assumption mean? Going concern assumption is believed that the business will continue its operation for the foreseeable future and there is no intention or necessity to close the business in the near future. This assumption is extremely important because almost every accounting treatment is based on the idea that business will continue to operate. If you assume that the business will shut down tomorrow, then preparing the profit and loss or the balance sheet becomes meaningless. Because of the going concern assumption, assets are recorded at their cost price and not at their current market value. The logic behind is that assets are purchased to be used in the business operation and not for the immediate resale. For example, if a business purchases machinery of rupees 5 lakh, the machinery is recorded as its cost and its value is gradually reduced through depreciation. We do not revalue the machinery every year because the business is expected to use it for many years. If the going concern assumption was not followed, assets would be shown at scrap or liquidation value. This would give a completely different and misleading picture of the business. Therefore, going concern assumption ensures proper valuation of assets, meaningful depreciation, and realistic financial statements. Without this assumption, accounting loses its practical relevance. The another assumption is consistency. This assumption states that once an accounting method or policy is adopted by a business, it should be followed consistently from one accounting period to another. Consistency does not mean that methods can never be changed. It means that the method should be changed frequently or without a valid reason, because changing unnecessary destroys comparability of the financial statements. For example, if a business uses the straight line method of depreciation in 1 year and changes to written down value to next year without justification, the profit figures will change not because of performance but because of method change. The main purpose of consistency assumption is to ensure comparability. When the same methods are followed year after year, users can compare current performance with previous years. If a change in accounting method becomes necessary, the change must be clearly disclosed along with its impact on profit and financial position. This disclosure maintains the transparency and trust in accounting information. And the third assumption, that is accrual assumption, is one of the most important concepts in accounting. According to this assumption, transactions are recorded when they occur and not when cash is paid or received. Under the accrual system, income is recorded when it is earned, irrespective of when the money is actually received. Similarly, expenses are recorded when they are incurred, irrespective of when they are paid. Let us understand this with an example. Suppose salary for the month of March is paid in April. According to the accrual assumption, the salary expense belongs to March because the employees worked in March. If we wait for cash payment and record the expense in April, the profit of March will be overstated and the profit of April will be understated. This will give a misleading picture of the business performance. The accrual assumption helps in calculating true profit of the business for a particular period and shows a realistic financial position. That is why modern accounting follows accrual basis instead of cash basis. So I hope till here everything is clear. In case of any doubt or question, you can type in the comment box. And now let's move to accounting principles. So accounting principles are the rules and the guidelines that accountant follow while recording, classifying and presenting the business transactions. These principles ensures that accounting is done in a disciplined and a systematic manner. Accounting principles are not arbitrary. They have developed over the time period based on experience and practical need of businesses. This principle makes sure that the profits are not overstated and the losses are not hidden. Without accounting principle, every accountant would follow his or her own judgment, which would lead to confusion, lack of comparability, and the loss of trust in financial statements. Accounting principles act like traffic rules. Just as traffic rules being order on roads, accounting principles bring order and consistency in accounting records. Revenue recognition principle. The revenue recognition principle states that revenue should be recognized when it is earned and not when cash is received. This principle is closely related to accrual assumption. Revenue is considered earned when goods are sold or services are rendered, irrespective of whether payment is received immediately or later. For example, if goods are sold in March and payment is received in April, revenue belongs to March. Recording it in April would distort the profit figures for both months. This principle ensures income is recorded in the correct accounting period and gives a true picture of the business performances. So it's important the revenue is recognized in the proper period. Let's look at matching principle. What does matching principle mean? So the matching principle states that the expenses of a particular period should be matched with the revenue of the same period. This principle is fundamental for correct profit calculation. Expenses are incurred to earn revenue. Therefore, expenses should be recognized in the same period in which related revenue is earned. For example, salary, rent, electricity expense incurred to earn March revenue should be recorded in March, even if it is paid later. Matching principle is the reason why adjustments like outstanding expenses and prepaid expenses are made in final accounts. And full disclosure principle requires that all material and the relevant information should be disclosed in financial statements. Material information is the information that can influence the decision of users of financial statements, such as investors, bank, and creditors. If the important information is hidden, users may take wrong decision. Therefore, transparency is essential in accounting. This principle ensures honesty, fairness, and trust in financial reporting. Let's look at accounting concepts and conventions. Accounting concepts. They are the basic ideas or assumptions on which accounting is based. Examples include business entity concept and money measurement concept. Accounting conventions are the customs and tradition followed over time to solve practical problems in accounting. Important conventions include conservatism, which means anticipating the losses but not profits, and materiality, which focuses on importance of the information. Concepts provide the base, while convention provides the flexibility and judgment in accounting. And with the above all explanation, there are the accounting standards, which are the rules issued by professional bodies to standardize the accounting practices. They ensure that similar transactions are treated in similar manner across the different businesses. Accounting standards improve the creditability, reliability, and comparability of financial statements. Following accounting standard is essential to present a true and fair view of the financial positions. So the base of accounting is the accounting standards, that is the rules set by the accounting standards, and this will ensure that every business follows the same or similar manner to record the similar type of the transactions. And we will learn about accounting standards in the later chapters in detail. Just to summarize this chapter and from exam importance. So basically, this chapter explains the logic behind the accounting rules and practices. It helps students understand why accounting follows certain principles and assumptions. Theory base of accounting is very important for theory questions in exams, especially question on assumption, principles, and standards. A strong understanding of this chapter makes future chapter easier and students develop accounting logic rather than memorizing the rules. So if the chapter is clear to you, please like the video and subscribe to the channel and comment your questions or doubts, and I will try to answer them all. Thank you.